Invest in stocks, invest in real estate. That's the basic advice most successful investors will give you when approaching them for financial counsel. But what is really the best option today? For someone new to investment strategies, choosing the right one can be overwhelming, and even if you manage to decide, knowing how to begin and maximize returns is another challenge. All that's because investing is all about risk. Making the wrong choice can result in significant monetary loss. But you need not worry any further. This video will help you bridge this gap and equip you with all the information you need to invest in real estate or stocks. The first rule to investing is to understand what you are investing in. When you understand what you are getting into and grasp how everything works, you can make informed decisions that will help you maximize your money. Let's start with real estate. According to Warren Buffett, the first rule of investing is never to lose money. The second rule is to never forget the first rule. To do this, I'll take you through a rundown of everything you need to know before investing in real estate and the various ways you can become a real estate investor. Basically, you'll get to know the pros and cons of real estate investment. Traditionally, real estate investment involves buying properties and either selling them after holding them for a while to increase their value or utilizing them as rental properties for residential, office, or storage purposes. However, real estate investment involves more than merely acquiring a building, renting it out, or holding it for a period before selling. It demands significant effort. You must be able to identify the right buildings or land properties to purchase and know when to sell. Additionally, you must be aware of all the other factors beyond the physical structure itself, such as taxes and ownership requirements applicable to buildings in your state or country. Many people believe that you need a significant amount of money to enter real estate investment, and that's true if you're following the traditional route of purchasing properties. However, there are numerous ways to invest in real estate without personally managing buildings. People often fail to understand that real estate investment doesn't necessarily mean you must be directly involved in managing a property, dealing with tenants, and ensuring everything runs smoothly. These responsibilities can be daunting and time-consuming, which discourages many potential investors. Let's examine 6 other ways you can invest in real estate. 1. House flipping. House flipping involves buying a property and holding it for a while before selling it for a higher price. Now, there are 2 ways you can go about this. The first is to buy a building that needs repairs, renovate it, and then sell it at a higher price to cover all the costs and expenses incurred during renovation. The second way is to buy the property, hold it for a while, and then sell it. Typically, you would hold the property for about 3 to 4 months before selling. The environment is very important when you want to buy property. That's why you should look for neighborhoods where people would love to live when considering house flipping. If you buy a property in an area where people aren't keen on moving in, the value of that property may decrease instead of increasing. So, you'll want to seek out the best environments when investing in real estate through house flipping. 2. Real estate investment groups. If you're interested in investing in real estate but don't have enough money to buy an entire building, this could be a suitable option. There are alternative methods for those who lack the time or funds to engage in traditional real estate investment. In fact, you can start investing in real estate with as little as $1,000. Here's how it works. A company purchases a whole building and then sells small units within the building to interested individuals. These real estate investment groups are responsible for acquiring tenants, managing the building, and handling other tasks while you own the units you've purchased. For instance, if you can afford to buy 2, 3, or 4 units within the building, you pay for those, while another person buys as many units as they can afford. This way, you're investing in real estate without having to manage the building yourself. However, the company typically takes a percentage of the rent as compensation for their services. 3. You have REITs, real estate investment trusts. A REIT is a company that owns, operates, and manages a large-scale income-producing real estate venture. Income-producing means that they own rental properties across various property types, such as malls, office spaces, residential buildings, etc. With this, they earn rent and can also realize capital gains by selling a building. They own diverse commercial real estate and handle all aspects of managing the buildings, including acquiring tenants and other related tasks. These companies are often publicly traded, which means they are open to investors. As an individual, you can purchase stocks from these companies. By doing so, you can receive dividends from the rents the company collects. This works similarly to normal stocks, where you go to the platform of the company, buy the stocks, receive dividends, and hold them for as long as you want before selling if desired. 4. There is also wholesaling. This real estate investment method operates differently. Here, you identify properties and then recommend them to investors. The investor purchases the property, and you receive a commission from the sales process. Essentially, you act as a middleman between the buyer and seller without directly buying the property. 5. You can also try out real estate syndication. This involves real estate crowdfunding, where multiple individuals come together to invest in real estate. The group typically consists of investors and a sponsor. The investors provide the capital, while the sponsor brings expertise and experience. The sponsor identifies potential properties for investment and manages the building after purchase, while the other members of the group contribute financially to the purchase and other expenses. Now that you've learned about the various ways you can invest in real estate, here are some tips to guide you. 1. Buy more than one property. If you are dealing with units, aim to purchase at least 16 units. 2. Don't make your first purchase solely based on your budget. 3. Stay informed about market trends and developments. 4. Always ask questions when you're unsure about any aspect of your investment. 5. Remember that location plays a significant role in real estate investment. Now that you've understood real estate investment and how it works, let's examine the stock market. Here's all you need to know about investing in the stock market and how to go about it. Investing in the stock market involves buying a part of a company through its shares and becoming a shareholder. This means that you now own a portion of the company, and your profit grows as the company grows. However, it's important to understand that whatever happens to the company will affect the value of your investment. Therefore, it's crucial to research the company thoroughly and assess its potential for future growth before investing in its stocks. To minimize this risk, you can invest in index funds. An index fund, whether it's a mutual fund or an exchange-traded fund, ETF, is an investment vehicle designed to mirror the performance of a specific market index by holding a predetermined basket of stocks. Index funds allocate assets to stocks and bonds tracked by the benchmark, either in their entirety or through a representative subset. Fund managers may engage in buying and selling securities to align the fund's performance closely with that of the index. There are different types of index funds, and a popular one is the S&P 500. This fund contains shares of the 500 most powerful companies. When you invest in this fund, you can be assured that one company's performance may not directly impact your investment, as it is diversified across multiple companies. Here are some tips to guide you. 1. Choose the type of stock you want to invest in. 2. Decide on a starting capital. 3. Understand the market. 4. Start investing. 5. Commit to holding the stocks for a long time. Before we close the chapter on these two investment types, it's important to clearly compare investing in the stock market and investing in real estate. This will help you make an informed decision on which option is right for you. Let's examine the differences between stock market investment and real estate investment based on the following points. 1. Capital required. Although you can start investing in real estate with a small sum, investing in stocks requires less capital than real estate investment. Getting started in real estate typically demands a larger initial investment than stocks. 2. Liquidity. It's relatively easy to sell your stocks and access your funds with a few clicks on your phone or device, even from the comfort of your home. However, the same cannot be said for real estate. Liquidating real estate assets involves a lengthy process. In emergencies, you may face challenges in quickly liquidating your real estate investment to attend to urgent situations. Selling a property can take a significant amount of time as it involves finding buyers, completing paperwork, and transferring ownership, which can be time-consuming. 3. Amount of work involved. Real estate investment requires a significant amount of work compared to the stock market. While investing in stocks also demands effort in understanding and studying the market, real estate entails even more work. It involves extensive research to find the right property, secure tenants, manage it, and handle various maintenance tasks. The level of work involved in real estate investment is considerably higher. 4. Risk involved. The stock market is known for its high volatility, requiring investors to tolerate a certain level of risk. On the other hand, real estate is often considered a more stable form of investment. Real estate investments can provide a hedge against inflation and are less susceptible to drastic market fluctuations compared to stocks. 5. Ease of purchase. Buying a real estate property involves a complex and time-consuming process. It requires various steps, such as property search, negotiations, legal procedures, and paperwork. In contrast, purchasing stocks is relatively easy and convenient. With just a few clicks on your phone or computer, you can buy stocks instantly. The ease of purchase is significantly higher in the stock market compared to real estate. Deciding between investing in stocks and real estate alone may not provide your portfolio with the diversity it needs for optimal growth. It's important to recognize that stocks and real estate investments can contribute to a well-diversified portfolio. Diversification is key to building wealth through investment, as it helps spread risk across different asset classes and sectors. Thanks for watching, and see you in the next video.